Welcome to Chapter 26 of the Canadian Securities Course, Volume 2. In this chapter, we will be discussing working with the retail client. So first off, the financial planning approach. So there are 4 objectives that must be considered when creating a financial plan. First off, the financial plan should be achievable. It should accommodate changes in lifestyle and income level. It should be realistic rather than daunting, and it should provide not only for necessities, but also for rewards. Now, there are 6 different steps in the financial planning process. They are pretty straightforward, but first you will want to establish the client-advisor relationship. Second is collect data and information. 3, analyze data and information. 4, recommend strategies to meet their goals. 5, implement recommendations. And 6, conduct a periodic review. So step 1, you will want to start by interviewing the client and identifying issues, both known and unknown, and you'll want to determine how a financial plan might help address them. So some questions might include the following areas of discussion. You might want to talk about the financial planning process and how it will help your clients meet their objectives. You want to probably mention some alternative strategies to choose from, specialist expertise required for specific choices, and the disclosure of possible conflicts of interest. Now, once you have established the relationship, you will want to focus on collecting the data and information. So for this, you'll want to specifically gather the following information: current financial and personal status, investment goals and preferences, level of risk tolerance, some personal data, net worth and family budget, and you must also understand their psychology as well. So whether or not they are more risk averse, if they are comfortable being in the market, comfortable with investments that fluctuate or not, or maybe there's someone who really can't stand risk and they really want their principal protected. So understanding if they're looking for growth, if they're looking for preservation of capital, or whatnot, or income, that is really important as well. Now, step number 3 is to analyze that data information. It is quite straightforward. There is an example here from the textbook that I won't go into, but basically you'll just want to analyze that data that you have collected, and then you're going to want to figure out some recommendations and actually recommend the strategies to meet these goals. So once all the data is collected and analyzed, you should have been able to create investment objectives and constraints, and recommending strategies according to these objectives and constraints are extremely important. Now, after you have prepared the plan, you should review it with your client, making sure that they understand each chosen product and they are aware of the risks as well as the potential rewards. Step number 5 is implement the recommendations, and at this stage, the client begins to put in motion and carefully consider the ideas and strategies recommended. So step 6 is just conduct a periodic review and follow up. So financial plan, it should never remain static. It must be reviewed regularly, and it should be updated to reflect the changes in the client's situation. So changes may warrant a new financial plan, and recommendations can also be made as things to change. So these can be minor or lengthy changes, but in any case, you must follow up with the client afterwards. For example, if you do have a portfolio built for a client, of course, the asset allocation does change as the investments grow. So you might want to rebalance that. That's something you would want to do during these reviews and follow-ups. Another really important section in this chapter is understanding the life cycle hypothesis. I would argue this is probably the most important part in the chapter, and you'll see a lot of questions on this that will be on the exam. So there are 5 different life cycles or life stages. First is the early earning years. Second, you have family commitment years. Third is mature earning years. Fourth is nearing retirement, and fifth is retired. There are some approximate ages here as well. However, they do vary depending on the client. Some general assumptions with the life cycle hypothesis is that older clients, they tend to be more risk adverse than younger clients. Also, younger clients tend to focus on shorter term financial goals, such as saving for a major purchase. It could be a home, it could be a car, some things like that. Whereas older clients, they tend to focus more on retirement and estate building or estate planning. So stage 1, the early earning years. Now, an approximate age is age 18 to 35, but really these earning years, they generally start when a person begins to work, and it ends when the family commitments begin to impose financial demands. Now, what it means by family commitments, it more so means about children. Children, they do cost a lot of money, so when they do impose the financial demands, then that's when you would move into the second stage, which is the family commitment years. But stage 1 investors, they are free of family and financial commitments. So they are interested in saving, but also their goals are typically short term. And since stage 1 investors have longer time horizons, they typically can tolerate a substantial amount of investment risk. And when they do invest long term, they are more likely to allocate most of their funds in riskier investments, such as an asset allocation of 20/80. Now, stage 2, the family commitment years. So an estimated age is about age 25 to 50, but it really starts whenever you have children. So a typical stage 2 client, they are fairly young and they're married with children. The arrival of children does have a major impact on the client's goals and their ability to attain them. And really the difference between stage 1 and 2 is the number of commitments and their level of responsibility, because they do now have children. So one distinguishing characteristic is the lack of liquidity, such as mortgage and car payments. So they do have a lot of those financial burdens or financial commitments. And it is typically difficult for stage 2 clients to save for the long term. As salaries increase, more savings can be deployed into medium-term goals such as RESPs for the children and eventually retirement. Now, do keep in mind that some people that don't have children at all, they could skip this stage entirely, and they would move straight from stage 1 to stage 3, which is the mature earning years. Now, an estimated age is age 45 to 60, but the point where clients move from stage 2 to 3, it greatly varies. So the critical factor that determines this transition from the family commitment years to the mature earning years, it almost always is the family's level of disposable income. So a dual income family in a high tax bracket, meaning they're making lots of money, they will have a short stage 2, whereas a single income family in a lower tax bracket, they might never even leave that stage. And clients at this stage, they're probably not much more risk adverse than they were in stage 2. A general asset mix could be 40-60, so 40 fixed, 60 in the market. And however, their asset allocation, it is likely to shift back towards a higher weighting in equity funds at this age as well. Now, stage 4, it is nearing retirement. And these clients, they're generally in their peak earning years, and they may be financially as well off as stage 3 clients or even better. So stage 4 clients, they have fewer family commitments. Their children are typically grown and have left home. And clients in this stage, they may shift towards a more risk-averse strategy, since they will have to rely on their savings to maintain their standard of living once they are retired. And of course, stage number 5 is when you are actually retired, and you'll be in this stage for the rest of your life. So at stage 5, the clients, they are faced with a conflict. They do rely on their retirement savings to maintain a certain standard of living, but they also need to keep sufficient funds invested to generate enough return to live off of. So usually they shift towards less risky investments, and the equity component declines in favor of less volatile fixed income. So they have that safety because they are actively drawing on this money or savings to provide them an income for the rest of their life. And here is just a quick summary of the life cycle hypothesis. However, we did go through each of the 5 stages. Also, in this chapter, it is important to understand ethical decision making and the 5 primary values. You might be tested on this on the exam. So the first primary value is duty of care, and this basically means that you must conduct due diligence before providing advice or recommending investments, and you really do need to know your client. Unsolicited orders, they are sort of under duty of care, and it is basically an order entered by a client that was not recommended. It is your responsibility, it's your duty of care, where you will need to caution the client, and you'll need to give them cautionary advice with respect to that unsolicited order if it does appear unsuitable based on the client's profile. Integrity is another primary value, and the client's interest must be your main consideration in all business dealings, and you must disclose all potential conflicts of interest. Professionalism, you must always act in a professional manner and avoid personal, financial, or business dealings with clients. You must also limit personal trading activity and continue your education so you can stay up to date on factors that influence the investment industry. Compliance, so your conduct must always be in accordance with the Securities Act of the province or provinces in which you are registered. And confidentiality, you must treat all information concerning your client's transactions and accounts confidential. You must not disclose any information except with the client's permission. So anyway, that is everything that I found important from this chapter. I really hope you found this review helpful, and again, stay tuned for the final chapter of the Canadian Securities Course.